All right, everyone. Welcome. Today, we are diving into a really powerful strategy that savvy investors use to turn market losses, something we all hate, into actual tax savings. It's called tax loss harvesting, and it's a real game changer.
So let's just start with the question I think every single one of us with a brokerage account has asked ourselves. You watch your portfolio climb, you feel great, but there's always that little voice in the back of your head that knows, when you sell, the tax man is coming for his cut.
Well, in this explainer, we're going to show you exactly how to flip the script. We're going to show you how to turn those market dips, those red numbers in your portfolio, into a genuine financial advantage. So yeah, let's get right into it. First up, we've got to understand the enemy we're all fighting. And look, it's not just the market going down. It's this invisible force that's at work even when you think you're winning. It's called tax drag, and it's basically the silent killer of compounding. Think about it. Every single dollar you have to pay in capital gains tax is a dollar that's no longer in your account, no longer growing and working for you. Over time, that really adds up.
Now, this is absolutely crucial. This strategy only works in your standard taxable brokerage accounts. We're not talking about your 401k or your IRA. In those tax-sheltered accounts, the IRS doesn't see gains or losses from year to year, so tax loss harvesting it doesn't apply. It's a non-starter there.
So, how do we actually fight back against this tax drag? Well, let's get to the solution. And it's really all about a mental shift, about changing how you think about what a loss even is.
And this quote just nails it. When one of your investments is down, selling it isn't about admitting defeat, not at all. It's about proactively creating a valuable tax asset. And what is that? It's a deduction that can save you real, cold, hard cash on your next tax bill.
So here's the basic playbook. It's a simple 1, 2, 3. Step 1, you find an investment that's in the red. Step 2, you sell it. That makes the loss official in the eyes of the IRS. And then, step 3, you take that loss and use it to wipe out a taxable gain you have somewhere else in your portfolio. Simple, right? Okay, this all sounds a little too good to be true, doesn't it? Well, the IRS is no fool. To do this right, you have to play by their very specific set of rules. And trust me when I say specific, I mean very specific. You see, the IRS has this strict order of operations. It's a pecking order. First, you have to use your short-term losses to cancel out short-term gains. Then, long-term losses against long-term gains. Only after that can you mix and match them. And if you still have losses left over, you can use up to $3,000 to lower your regular income. And anything beyond that, you can carry it forward to use in future years, indefinitely.
So what's the big takeaway here? It's that short-term losses are absolute gold. Why? Because they first go up against short-term gains, and those are the gains that get taxed at your highest income tax rate, sometimes up to 37%. Wiping out a gain that's taxed that high is a massive, massive win.
But here's the big catch. There is one major rule designed to stop people from gaming the system, and you absolutely have to know it. It's called the wash sale rule. Basically, you can't just sell a stock to get the tax loss and then buy it right back 2 seconds later.
And here's the number you have to burn into your brain. 61 days. That's the critical window. It's 30 days before the sale, the day of the sale itself, and 30 days after the sale. If you buy back something substantially identical inside that window, your tax loss is denied.
Now, what does substantially identical even mean? Well, the IRS is a little vague on purpose, but here's what most pros agree on. Selling, say, Ford stock to buy GM stock, totally fine. They're different companies. Selling an S&P 500 ETF to buy a Russell 1000 ETF, also fine, different indexes. But where it gets sketchy is selling one S&P 500 ETF to buy another one from a different provider. It might track the same index, so most advisors say just don't risk it.
Okay, everyone, please pay close attention here because this is probably the most dangerous trap of all. The wash sale rule applies across all of your accounts. So if you sell a stock at a loss in your brokerage account and then you buy it back inside your IRA within that 61-day window, boom, it's a wash sale. But here's the killer part. Because an IRA has no tax basis, you can't just add that loss to the cost of the new shares. It's just gone forever, permanently forfeited. It's a brutal mistake to make.
All right, now that we all know the rules and how to stay out of trouble with the IRS, let's look at how to actually pull this off effectively. And more importantly, what kind of real-world impact can it have on your returns?
So what's this actually worth? Well, research from Vanguard put a number on it. They call it tax alpha. It's the extra return you can generate just by being smart about taxes. and they found it can add anywhere from about 0.5% to well over 1% to your annual returns. And it makes sense, right? In a choppy, volatile year, you get way more opportunities to harvest those losses.
But there's a catch. The power of this strategy can actually fade over time because of something called ossification. It's a fancy word, but the concept is simple. After a really long bull market, your investments have gone up so much that even a pretty big market drop might not be enough to push them below what you paid for them. Your portfolio gets kind of stiff. No losses to harvest.
But there is a really powerful weapon against this. Just keep adding new money. A portfolio that gets regular cash infusions keeps its harvesting potential alive for way, way longer. Why? Well, every time you buy more, you're creating a fresh, higher cost basis. You're essentially reloading the cannon with new opportunities to harvest down the road.
All right, let's look ahead for a minute and see how technology and even new types of assets are completely changing the game. This isn't just something you do once in December anymore.
For investors with a lot of capital, the new gold standard is something called direct indexing. So instead of buying an S&P 500 ETF, which is like one big basket, you own all 500 stocks individually. Now think about that. Even if the S&P 500 is up for the year, you can bet there is still 150 or 200 stocks inside it that are down. Direct indexing lets you sell just those losers, giving you way, way more opportunities to harvest.
Now for a really wild corner of this world, cryptocurrencies. At least for now, they have this massive loophole. The wash sale rule only applies to stocks and securities. The IRS says crypto is property. So what does that mean? It means you can sell your Bitcoin for a tax loss and buy it back literally 1 second later, capturing the tax benefit without ever leaving the market. But you have been warned, regulators are working fast to close this loophole.
And you know, the benefits here go way beyond just your investment portfolio. By strategically lowering your income, harvesting losses can help retirees avoid those really expensive hikes in their Medicare premiums, the IRMAA surcharges. It can also help you avoid the tax torpedo on your Social Security benefits. It's an incredibly powerful tool for retirement planning.
So, what's the big idea here? The main takeaway is that tax loss harvesting completely reframes how you should look at market volatility. It's no longer just a risk to be afraid of. It becomes an opportunity to be seized. It's a way for you to take control, to lower your tax bill, and in the end, to keep more of your own money working for you.